Good morning, everyone. Welcome to SC&H Group's 2021 Year-End Tax Planning Forum, How to Maximize Outcomes, Identify Possible Deductions, and Navigate the Tax Landscape. My name is Andrew Thompson. I'm a Director and Financial Advisor with SC&H Financial Advisors, and I oversee our Wealth Management Division. We're thrilled you're able to join us today as we spend the next hour and a half together walking through some potential game-changing personal finance and business tax-related planning strategies. But first, let's go over a few quick housekeeping items. All attendees are on mute. If you have a question, please ask them via the Questions tab on your screen. Our presenters plan to answer as many questions as possible at the end of each section. Today's webinar is going to be recorded and it's going to be shared via email on Monday, December 6th. In order to secure your CPE credits, please answer all of the polling questions that will be asked throughout the presentation. A CPE survey will be emailed to you tomorrow, so please fill it out to ensure that you receive your CPE credit for attending. Today, we're going to cover a wide range of topics, which include individual tax and financial planning, business tax planning, corporate tax planning. We'll have a wrap-up and a Q&A as well. We'll be covering proactive strategies to identify and capitalize on 2021 tax opportunities, tax implications based on current rates and federal state law changes in 2021, critical information about qualified plans, distribution and retirement and estate planning, and regulatory tax changes expected in 2022 and proactive strategies. Our featured presenters today will be Amanda Wilhelm, James Eaton, Jim Wilhelm, Stephanie Johnson, Michael Bondi, and me. All right, so let's get started, shall we? I'm going to start things off by covering a few strategies we commonly implement that have given our clients tremendous success over the years. Now, while tax law is never definitive, there are a few bedrock concepts that have been with us for generations and are likely to stay. Now, I'd be willing to bet that most of you at this forum own mutual funds, and many of you own them in an account that's not a tax-sheltered account, such as an IRA or 401k. This means that any income derived from that holding during the course of the year is going to be subject to tax. Capital gains, dividends, and interest are all forms of taxable income, whether or not you received them or whether they were reinvested. So one commonly overlooked aspect of a mutual fund is its tendency to distribute any income realized during the course of the year to its share owners proportionally. Therefore, if the fund manager sold shares of Apple within the fund for more than she paid for it, you, the mutual fund owner, realizes that gain and you subsequently owe the tax on it. The distribution of the taxable income may occur throughout the year, but most commonly it's going to be distributed near the end of the year. Typically first, second week of December, referred to by and large as a year-end distribution. So this gives share owners the ability to sell the fund prior to the announced year-end distribution date and thus avoid the tax liability on the distribution. Unfortunately, this isn't realistic for most, as the investment may have appreciated significantly over the course of the year, or since you've owned it, thereby rendering that sale taxable. Further, those mutual funds that are considered active, in other words, the fund manager is attempting to beat an index by buying investments it believes will outperform others, will generally realize more transactions throughout the year and thus more capital gain distributions to its share owners. Remember, the fund manager publishes their gross return before taxes, since the mutual fund is not a tax-paying entity. This means even though its published calendar year return might be, say, 10%, but it distributed a capital gain equal to 15% of the fund value to share owners, your net return is 10% less the tax you owe on that 15% distribution. Let's take a look at the example that I'll show here on the next slide. Depending on your tax rate, this could result in a net return, on the next slide you'll see this, of as low as 5%. We figure state of Maryland, federal tax filing, call it 30%, in total. After your 10% return, you pay the tax, you're only keeping about 5. So it's not what you make, but rather what you keep that matters. So what can we do about this? Well, for starters, know what you're buying before you buy it. Your financial advisor should have a thorough understanding of this relationship based on the fund's strategy and distribution history, and that should certainly be made clear to you in advance of that purchase. 2, if you own a fund that is projected to distribute a significant gain prior to year end, and this year is one of them, consider the trade-offs of selling it prior to the announced distribution date. You'd have to weigh what your realized gain would be if you were to sell it versus what the distribution amount is going to be. And sometimes that break-even point could be as little as 1 year, 2 year, 3 years, I could argue, might even be appropriate, because as long as you own that fund, each and every year after that, you're going to have the distributions to worry about, even though you didn't take any action yourself. 3, if you have positions in the account with unrealized losses, you bought it, it's declined, but you still own it, consider selling them and using that to offset the capital gain distributions. You can buy it back, certainly after the fact, and reestablish that higher basis. You just have to buy back something similar. If you want to buy the same thing, you have to do it 31 days after. Otherwise, the loss is not counted. 4, if you insist on owning an actively managed mutual fund, own it in a tax sheltered account like an IRA or a 401k. The year-end distributions in that case are going to be meaningless to you. 5, consider buying something like an index mutual fund, an exchange traded fund, or ETF that are consistent, certainly, with your financial plan. We don't want the tail to wag the dog here. So first and foremost, make sure that investment makes sense for you. Now, you can get the same expected long-term returns from these vehicles and avoid, in almost all cases, not in every case, the tax hit on year-end capital gain distributions by owning those types of funds, particularly the ETFs. And finally, 6, consider gifting some shares of your mutual fund to a charitable organization, provided you're charitably inclined to begin with. You were already going to plan to give. And that is a perfect segue into our next discussion, which talks a little bit about effective charitable giving. Under current law, you're limited to $10,000 in state and local tax deductions, otherwise referred to as a SALT deduction. Therefore, anyone living in a high-tax state such as Maryland, New York, California, New Jersey, Connecticut, the state taxes you pay can even be more crippling. In some cases, as high as 13%. On top of your federal tax. This also means you're far more likely to take the standard deduction versus itemizing. With the standard deduction somewhere around the $25,000 range for those filing joint returns, you'll need at least a combination of $15,000 in additional deductions, such as mortgage interest, healthcare expenses above 10% of your adjusted gross income, and charitable donations before receiving any incremental benefit of itemizing. Now, let's say you're charitably inclined and want to give $10,000 to $15,000 to a charity this year. Unless you have mortgage interest or paid a significant amount of healthcare expenses, you're not going to receive any tax benefit for that donation. You're still going to take the standard deduction. Remember, $10,000, you're capped on your state taxes paid, so $15,000 still gets you below that line. Further, should you give away, say, $20,000 to a charity and have no other deductions but state taxes paid, you're only going to see a deduction or a benefit of that charitable donation on $5,000 of that $20,000 donation. So what can we do about it? If you're considering a gift to a charity in excess of $5,000, either this year or next, or if you give annually and expect that to continue indefinitely, consider the following strategy. Let's take a look at the visual on this one. First, step 1, establish what's called a donor-advised fund. This is a 501c3 charitable organization that acts essentially like a brokerage account. It's got your name on it, allows you to donate cash, securities. You can even donate collectibles. You can even donate art as long as it passes a appraisal process. You may then take grant requests from your account, from that donor advised fund, and send it to any qualified charity of your choice, either immediately or years into the future in increments as low as $25. We typically help our clients set one of these up through Fidelity Charitable, which is the second largest private charity in the world behind the American Red Cross. Significantly lower fees and expenses than any of the other ones that certainly that I'm aware of. But here's where it gets interesting. I mentioned you may donate securities. So therefore, if you own stocks, mutual funds, ETFs, let's say in a brokerage account, not an IRA or 401k, but a regular account, and they've increased in value since you bought them, right? So if you sold them, you'd have a capital gain. You may donate any amount of those shares of those securities to your donor advised fund. That allows you to avoid any of those embedded capital gains. Remember, think year-end distributions. And you get a tax deduction based on the fair market value of the donated shares at the time of the donation. You then use the cash that you normally give to the charity and you buy back the shares you just donated. You establish a higher cost basis. So you don't, if you're attached to, say, your Apple stock and you want to hold on to it, you can still hold on to it. Just donate the shares, and the check that you were going to write, use that to buy back that stock. To take the strategy one step further, let's say you usually donate $10,000 per year to a charity, and you do so typically in cash. So we talked about the impact of the standard versus the itemized deduction. Remember, you're getting no tax benefit on this size donation. So consider accelerating several years worth of giving into 1 year, thereby making the most out of each dollar donated. You may then gift out any portion of that donation that you made into that account to any of the charities you normally give to on your timetable. You get the deduction for the year of the donation to the account, to the donor advised fund, and then either immediately or over the course of, say, the next 5 or 10 years, you can gift out in any denomination anonymously or in your name. And last but definitely not least, for anyone who's 72 and older, who has an IRA or other qualified retirement account, and we'll see this on the next screen, let's talk about one more invaluable consideration. It's called a qualified charitable donation, or a QCD. By December 31st of the year you turn 72, and every year you're alive after that, the IRS requires you to distribute a minimum amount of your retirement account. That distribution is then taxed at ordinary income rates. So if you're a Maryland resident, it's also taxable at the state level. However, for those who are charitably inclined, you may donate up to $100,000 of your RMD. It's 100% of the RMD up to $100,000. Avoid all of the income tax on the distribution that passes directly to the charity. So you want to be sure not to take possession of that money. You cannot have the check sent to you and then you send it to the charity. It's got to go directly to the charity. We commonly work with our clients to help them institute strategies like this one and strategies that we talked about that have to do with the year-end capital gain distributions, how to mitigate whenever possible. We don't like paying tax. We're certainly happy to pay our fair share, but we don't like to pay a nickel above that. So I hope you found this information helpful. If your advisor isn't bringing you ideas like these to you, consider giving us a call. We'd love to talk to you. So we've got a polling question here. Polling question number 1, true or false? Highly appreciated securities are an ideal candidate for charitable giving. And the answer is true. And now I'm going to turn it over to Amanda Wilhelm.
Okay. We're just waiting to wrap up with the polling question. Okay. Well, thank you, Andrew, and thank you everyone for joining us today. We really appreciate it. And I want to apologize off the bat for my voice, a little bit of a scratchy throat. No COVID, but just the typical bit of a cold. So anyway, but again, thank you for joining us. It's hard to believe that we are in another year of another year-end planning season. It's upon us, and like in years past, we are faced with some potential impactful tax law changes. Uncertainty it's still the name of the game when it comes to planning. As we look at our slide, we're going to talk. I'm sure many of you heard about the bill that's out there, the Build Back Better Act. Say that fast 3 times, or the Triple B bill, as Jim Wilhelm likes to call it. It's currently working its way through Congress. I'm not going to steal Jim's thunder, as he's going to be speaking to the House provisions of the Act after my presentation, but the items noted on the slide, these were left to me to address. For those of us doing individual planning, these are very important to keep in mind. Now, again, none of this is law, but the House version of this bill would have impact on planning with retirement accounts. We could be faced with limitations on contributions to accounts that exceed $10 million, elimination of backdoor Roth conversions, and I'll touch on this again in more detail, and the end of Roth conversions for those whose income exceeds the noted limitations. You'll see here dates are staggered on these provisions, so there's still some time to use them, except for the backdoor Roth. That could be finished after December 31st of this year, and again, we'll touch on that. So let's talk about some facts with regards to retirement planning. Just some recap here, some fun facts. The 2020 Secure Act allowed for some taxpayer-friendly provisions, which are still in effect. There's still no age limitation on IRA contributions as long as you have earned income. Also, the RMD, the required minimum distribution age, is 72 as opposed to the old 70 and a half age, which allows for more time to keep that tax deferral going and converting some of those funds to a tax-free Roth if the tax math makes sense. Quick reminder, the RMD waiver that was available for 2020 hasn't been extended to 2021. That was something specific to COVID, CARES Act, and all of that. So be sure to keep that in mind if you have not yet taken your 2021 distribution. So let's talk about some planning. Let's start with as far as your actual employer plans. You want to think about contributing the maximum you're allowed to your employer-sponsored plan. We say that we need a 401k, 403b. That's always a smart move if you have the opportunity to do that. If it's a traditional plan, you take advantage of tax savings now while enjoying the benefit of those funds growing tax deferred. You'll see the max contribution amounts noted on the slide, and it's just something you definitely want to keep in mind. Those of you who are self-employed, be sure to take advantage of the SEP IRA or the solo 401k. Depending on your income level, you could put away close to $58,000 for 2021 and receive a current tax benefit. If you're not already using this strategy, definitely want to reach out and speak to your advisor about it. We definitely work with our clients on those issues. One last thing before we go to the next slide. If you can't do the max contributions to your employer plan, at least try to contribute enough to get the match if one's available. Otherwise, you could definitely be leaving money on the table. Same mantra for IRAs, individual retirement accounts. Be sure to max those out whenever you can. Even if you don't receive a current deduction, you have funds growing tax deferred or tax free in the case of a Roth IRA. If you're like, I'm not sure how much I can put in this year, you have until April of next year to fund those accounts for this 2021 tax year. So I'd like to now, let's circle back to some of the topics I'd mentioned previously while outlining this on the next slide. Let's talk about backdoor Roth and Roth conversions. If we could flip to the next slide. Yep, there we go. So actually, if we could go back, please. Sorry about that. What's a backdoor Roth contribution? It's a current strategy to get around the Roth IRA limitation, and one that the Triple B Act would eliminate after this year. One can contribute to a non-deductible IRA and then immediately convert that amount to a Roth IRA. There's some nuances to this, that have to be thought through, but if you haven't considered this tool, definitely talk to your advisor about it. Roth conversion, again, pretty simple as far as mechanics. You take your traditional IRA, pay the tax on it, and those funds convert to a Roth IRA. Why do this? You could look to pay tax on that IRA now at potentially lower rates and then have the funds grow tax-free. That's hard to beat. The key here is managing your tax bracket. You'll see on our next slide the current tax rates. For most of our clients, we look to fill up that 24% rate bucket when we're considering these strategies. It's a big opportunity that we consider for our clients each year. But given the potential rate increases, you're potentially losing this tool altogether, I highly recommend looking into this for your own personal planning. As we wrap up retirement planning, let's not forget about some planning opportunities for our kiddos. One of the best ways to get our children on the right financial track is to set up IRAs for them. I know retirement is years away, but that's exactly why setting these up now makes sense. The funds will have many years to grow tax deferred or tax free. They must have earned income to do this. So it's easy for the teen who has a part-time job at Chick-fil-A. You can contribute the lesser of $6,000 or the maximum amount of their earnings for the year. What about the younger ones or kids of our business owners? You can put them to work for you, have them on your payroll. Looking at that, you're receiving a deduction on the business side for payroll, and the kids are earning income that qualifies them for IRA contributions. Again, it's a nice tool to consider. This then takes us to our second polling question. So let me see here. What is the name of the proposed bill currently being debated by Congress? The Build Back Better Act, Biden's Big Deal, or like most of us, sorry, I've lost track. For those of you looking, the Build Back Better Act is the name. So now we're going to jump into just talking about some basic tax planning. As I said before, uncertainty is still the name of the game in tax planning. We have to plan using the current law, but most of us, we have to be aware of potential changes. Again, Jim will be touching on the current pending legislation, but let's not lose sight of what is set to change, even with no new laws. In 2025, the TCJA, that what most of us refer to as tax reform of 2018, that all sunsets, and a number of rules, including rates, go back to what they were in 2017. I think a lot of us sometimes forget about that because we're so busy trying to keep up with what is changing in the meantime, but it's important to keep those 2025 changes on our radar. Tried and true year-end planning, it's always been the mantra of defer income and accelerate deductions. But again, the prospect of increased tax rates does make us question if that's the best course of action at times. Recognizing some income now at known lower rates and kicking some deductions forward can mean more in tax savings in future years. I've noticed some planning thoughts surrounding potential changes, but before I touch on them, I want to say that it is so important that you pair your tax planning with your overall financial planning. Most of the items I'm going to touch on and those that Andrew discussed all involve considering both the tax and investment impact. Our teams here at SC&H, that's what we do every day. We consider all of these issues and apply them in a customized fashion for each of our clients, so that for each decision that's made, we're thinking about tax and investment planning. You have to make sure you consider both when you're doing that. So what are we thinking about for clients? We're looking at portfolios and converting ordinary investment income like interest into qualified income. For some, we're actually generating capital gains now to take advantage of those lower rates still in place. For multi-year planning, Roth conversions, what we spoke about earlier, we use those amounts of income to fill up those lower rate buckets. Maybe think about negotiating your bonus or a payout into the current year while you can lock in the lower tax rates. Finally, for our married folks, always review and compare the impact of your filing status and take advantage of that reduced marriage penalty while you can. It's a romantic conversations for you couples out there, right? Some things to keep in mind for our business owners. Let's go back a slide, please. As of now, you still have the benefit of the QBI or qualified business income deduction. I'm sure by this point, most of you are very familiar with the mechanics of this deduction, so I won't go into the details. If you're an SSTB, will be a specified service, trade, or business, you want to look to keep taxable income below the 2021 limits. For each year, it makes sense to review your wages, assets, or even choice of entity to make sure you're in the best position to get the most out of this deduction. It could also be another part of the tax code that could possibly see some major overhauls in the future if certain senators get their way. As we wrap up our income tax planning discussion, some of our tried and true tips may still be the best route for you for 2021. Depending on your circumstances, you may want that bonus to be deferred to next year. As I'd mentioned previously, maybe it just depends on where you are. Do you want to accelerate it or push it off? Always keep an eye on the level of passive income and losses that are being generated year over year. See what you can do to generate what is needed to absorb passive income or release those built up losses. Finally, at a minimum, take a look at your withholding. Are you on track to have paid in enough to avoid those annoying underpayment penalties? If you think you're shy of the mark, reach out to your employer now for a last minute tweak of your wage withholding. Most of us have a couple of pays left between now and year end, so the opportunity is there. Itemized deductions. So let's talk about deduction planning, the good old bunching strategy. Tax reform has made this very popular. And again, under current law, it's still a great tool to consider. Most of us no longer need to worry about tracking and itemizing our deductions, but in those higher income years, focus on the timing of when you made that charitable donation or elective surgeries or medical needs. Push it to a year when income is higher or when your collective deductions, they far outweigh your standard deduction. State and local tax deduction. It's minor, but step back and consider whether you should deduct real estate taxes and sales tax instead of state income tax to hit that $10,000 cap. Remember, if you deduct income tax, you'll be adding that back on your state return. Again, it's a small amount, typically, but still something to think about. The Triple B bill, might have heard in the news that is looking to increase the SALT deduction with a cap. That could be in place in 2021, but again, stay tuned because that's coming up with Jim W's commentary there. Next, moving on about charitable giving. Andrew already did a deep dive on this item with a number of great planning ideas, so I'm not going to rehash that. One quick comment that I have for everyone is that the Maryland CITC program, Community Investment Tax Credit, that's still in place. A recap on this, the CITC program allows taxpayers, this is both individuals and businesses, to make a charitable contribution to participating charities. When you do so, you're able to take a federal and state charitable deduction. You also get to take a Maryland income tax credit for 1/2 of that contribution. The federal deduction is limited to the excess over the Maryland credit. It's what the IRS calls quid pro quo rule. But this is still a nice tax tool to consider, so I recommend checking out the website in the process. Mortgage interest. Given our discussion surrounding itemized deductions, it's just good to make sure you're fully understanding the current deduction limitations in place if you're purchasing a home, and reviewing what, if any, tax benefit you're receiving from the current mortgage. $750,000 is the current limit on home acquisition debt. So if you take on a new mortgage that exceeds the magic number that I just mentioned, and if you have a home equity loan that was used for anything besides buying or improving your current home, you're going to be limited on what you can deduct. So we've advised many of our clients since 2018 when the amounts changed, and we'll continue to point out this. Should you consider accelerating the pay down of your mortgage? I believe this should be considered by those who are no longer itemizing. Maybe you not have the most favorable of rates and could obtain a better rate or return elsewhere, and they have enough savings for all their other financial goals. So this idea is not just a pure tax answer, but something you should consider with your financial advisor, as it has more than just tax impact. Also, as we wrap up on this slide, not tax related, but given current tax rates, a refi could be a good move to consider. Rates are still pretty low based upon historical norms. Last point about planning around itemizing is just it's the continued suspension of miscellaneous itemized deductions. We're in year 4 of these new rules, but many still are not aware that they cannot deduct these miscellaneous items. Unreimbursed employee business expenses, professional fees incurred, we're talking legal, tax, advisory fees. They still seem to be the ones that probably cause a lot of frustration for all of us. Home office expenses for those of us who are W-2 employees. But again, for those tax and legal fees, we continue to make sure that these expenses are being correctly applied to self-employment income where we can, rental income, income from other business entities, so that those deductions aren't lost. You can also consider paying your investment advisory fees from your IRA. And I believe we brought this up at last year's seminar. In the past, the plan was pretty much the opposite. You wanted to pay your fees from taxable accounts, so you could take the deduction while letting the IRA money grow tax deferred. And that may still be the best strategy, as we don't want tax deductions to cloud our judgment. But I wanted to throw that out there for you to consider, as it may make sense for some of you. Definitely discuss that again with your financial advisor. Some miscellaneous items to consider as we wrap up our federal discussion. Let's not forget about 529 college savings plans and how they fit into your overall planning. Not only does a 529 plan provide federal tax-free growth and tax-free withdrawals if used for qualified education expenses, but most states offer some type of deduction or credit for contributions to their state's plan. And some states even allow for you to deduct contributions to any plan. Definitely something to keep in mind as you start looking to save for the little one's higher education. You can also use those funds for undergrad, $10,000 a year per student. So we're talking K-5 through 12 for a private school. Finally, make sure you're taking full advantage of any health savings accounts, flexible spending accounts, or dependent care FSAs. This is the time of year many of us are going through open enrollment for benefits at our places of employment, and the option to contribute to an FSA may be available to you. Potentially even an HSA, depending on your plan. So if your company offers a cafeteria plan that allows you to put away pre-tax dollars to a flexible spending or dependent care account, be sure to consider it. Remember, there are use it or lose it plans for many of these. The cost of childcare or the need, the cost of childcare, the need for new glasses or braces, you name it, it's going to create the need to fully spend what you put away, probably a little more. For 2021, the dependent care annual limit, depending on if your plan has made amendments, can be as high as $10,500. It's typically $5,000 per person. Because of COVID and such, they've just made that been a little more lenient on what you can put in and the timing of when you can take some of that money out. So definitely check with your employer's plan if you're able to put a few more dollars away this year. Let's transition here and take a quick look at the state side of things. I believe the bulk of our webinar participants, you probably are in Maryland, so I'll touch on where things stand here at home. Maryland continues to follow the 2018 tax reform with a few modifications. Maryland will still have personal exemptions in place. Phase outs are still around, so if your income exceeds $150,000, I believe it's still that amount, no exemptions will be available to you. For 2021, there'll be a slight increase to the standard deduction, which I outlined in the slides. Again, they continue to disallow a QBI deduction, as Maryland, they've done that in the past. They continue to decouple from bonus and Section 179 depreciation. Also to note, Maryland's estate tax exemption still around $5 million. That may catch some Maryland residents who have a large estate. So again, now, just with everything else, review of your estate plan is very important if you plan on staying in Maryland. So let's go to our third polling question. True or false? 529 contributions are eligible for a federal tax deduction. True or false? A few minutes, and that is false. Good job. Everyone's listening. I appreciate that. So as we go to wrap up, I'm just going to touch briefly on just do a brief overview of current estate and gift tax planning and considerations. And we could spend all of the webinar talking about these items, but just wanted to leave everyone with a few thoughts. So quick summary, you still have a federal estate and gift tax regime in place. There is currently an estate and gift tax exemption, or what we call lifetime exemption, of $11.7 million in place for 2021. And this is set to increase each year for inflation through 2025. What does this mean? This means an individual can gift up this amount to anyone during lifetime without paying any gift tax. Any amount of exemption left over can be used to reduce estate tax at death. These increased exemptions amounts, again, they're set to be around until the end of 2025, unless legislation comes along sooner, which it definitely could. That was they were planning on having that in the Build Back Better bill. It looks like that's going to be pulled out, but that could definitely rear its head again in 2022. So given that many are doing gifting and revising estate plans now to take advantage of these higher exemption amounts. So just very quick summary of some opportunities to consider. Outright gifts. Yes, this is as simple as it sounds. Consider those outright gifts to family and friends. Right now, each taxpayer, you can gift up to $15,000 to any unlimited number of individuals each year and not pay $1 of gift tax. Parents, grandparents, if you're helping out the kids or grandkids with education, private school, college, or if unfortunately you're assisting with medical bills, write those checks directly to the school or medical facility. They aren't considered gifts if you pay directly to the institutions. So if you're not using your annual exclusion or lifetime exemption when you're doing that, it's very powerful. One other thing too, the exemption is going to increase to the annual exclusion amount, excuse me, is going to increase to $16,000 in 2022, first time in a few years. You can also consider giftings to trust. Now, what I have noted here is not the end-all be-all, and I'm not going to get into the technical weeds of each of what I've listed, but I believe these are some of the top few that should definitely be considered. All three of these trusts noted allow an individual to utilize higher exemptions now to remove the future value from their estates while still providing benefit for themselves or their families. You have asset protection, and in the case of a charitable lead trust, obtaining a potential income tax deduction now. So I know I've thrown a lot of information your way. I really hope this was informative. Happy to, if anyone reaches out with questions, happy to address those. I believe we may have had a couple of come in. Going to go over, let's take a look at that here. Let's see, we have a question. You mentioned no age limit on, see here, mentioned no age limit on IRA contributions. Can an individual who must make RMDs during the year also make contributions to an IRA? Yes, I believe that is correct. There's no age limit as long to contributing as long as you are have the earned income. But I believe once you hit that 72 year age mark, you would have to start taking contributions. Okay. So with that,
well, we got one more with respect to one more question came in. I'm going to read that here. Frequently, charities fail to include FBO information for the benefit of on QCD distributions to charity. Some suggest having a check made out to the charity, but mailing to the individual to add FBO information. You mentioned inability to mail such a check to the individual for forwarding to charity, but if the check is made out to the charity, is that two-step mailing problematic? So just to clarify there, great question. What I meant by that is if the check is made payable to the IRA holder, that's a problem. You cannot then take the QCD. So what you can still receive the check, but you can have the check payable to the charity. That is completely fine. Have it mailed to you. You can then hand deliver it to the charity. Nothing wrong with that. Okay. So when you're completing the document, so for example, when our clients are doing this, we will pre-fill a form and just ask them that question: do they want it mailed to them or directly to the charity? But it is made out to the charitable organization. Hope that helps.
Let's see here. All right, I think at this point, I'm going to hand it over to Jim, and we'll dive into the business tax planning. Thank you, everyone.
Thank you, and good morning, everyone. Great job, Amanda. Good morning, James, who will be my partner in crime today, unfortunately for him. I'm going to run through what's sitting in the Triple B with the Senate right now. It has come from, I think if we can push the slide forward, please. There we go. Thank you. We have the House passed legislation a little while ago along party lines. The Senate needs to get a few centrist senators on board to pass this legislation. Mr. Sanders is also making a little noise. We're quite certain that this legislation will change between now and when it's converted to law. The latest from a timing perspective, which is always critical in the world of tax. I I think a couple of weeks ago, the target was before Christmas, but as of this week, it appears that it might not happen until early 2022. Probably the best news about this legislation is what's not in it. If we thought about where we were a few months ago, folks were pretty confident that ordinary and capital gain rates were going to be going up. Estate taxes were going to be going up, or exemptions would go down. Large corporate tax increases. There was going to be tax due if you made a gift, no step up in basis when assets passed at death. All of that is gone, which is good, I think. So what do we have in front of us at this point, as of December 2nd? Most of the changes I'm going to run through quickly would be effective in 2022. A couple would be effective starting in this year. The first one, and one of the biggest revenue raisers, would be a tax surcharge of 5% on taxpayers with adjusted gross income over 10 million, and an additional 3% surcharge if your AGI is over 25 million. You heard at least one person talk about the SALT cap. I think it's hysterical that it's even in this bill, but they are looking to raise the SALT cap from 10,000 to 80,000. This is actually pretty expensive depending upon how they model it. This would be a 2021 event according to the current legislation language. There's a little bit of irony here. The SALT cap was instituted at a time during the Tax Cuts and Jobs Act's implementation, where rates went down, but you lost some deductions, and it wasn't quite a push, but it was close. Here, rates would still be down from where they were in 2017, but they would give you some of your SALT deduction back. We'll see where it goes. Bernie Sanders is against this provision, views it as a giveaway to high income taxpayers, and it does create expense in the bill. So it's possible this is modified, limited, or eliminated as a provision. Section 1202 is in this bill, one of my favorite code sections. It allows sellers of a qualified small business that is held within a C corporation to exclude all or some of their gain. It's an incentive that Congress put into code back in 1993. The BBB would limit the 75% and 100% exclusions to only taxpayers with adjusted gross income under $400,000, which means for most folks who would have a gain that would otherwise qualify, they will not benefit at that level because the gain would probably push your AGI well over that number if it wasn't already over that threshold. The 50% exclusion apparently would still be available to everyone, again, assuming you are an eligible investor in a qualified small business stock transaction. One big one, a big revenue raiser, about 180 billion over the 10-year scoring period, would be to assess the net investment income tax, or the 3.8% Obamacare tax, to all business income. Right now, that tax is assessed on interest, dividends, capital gains, and passive income. It would be expanded to include non-passive income. So if you own and manage a business, own and manage real estate, and there is a taxable profit and your adjusted gross income is over $400,000, you would pay an extra 3.8% federal tax on that income. So if this does come through, once again, tax advisors and their clients might want to have a conversation about a different structure, i.e. C corporation structure, being a potentially better answer. Also in the bill, 461L, which is a limitation for usage of business losses against non-business income. This came out of the Tax Cut and Jobs Act. It would become permanent under the BBB. And there would be substantial changes to corporate taxes. A new minimum tax of 15% on book income, changes to the GILTI and FDII regimes that were created under the Tax Cuts and Jobs Act, along with a number of other provisions affecting very large or multinational corporations. Now, I think next slide, please. We have a polling question, number 4. So the BBB Act, the Triple B, is proposing to increase the SALT deduction limit from 10,000 to, you see your answers. Let's see how people are doing. Look at that. So we have a couple of comedians in the office. Thank you. No, it's not what Bernie Sanders pays. It's going to be 80,000 again under the current legislation. Stay tuned. And now James is going to walk us through some business year-end tax planning.
Well, thanks very much, Jim. As a sort of a reset, let's think about this, right? So some of the things we're going to talk about are businesses. We're going to talk about business planning for the year end. But you're going to say, hey, Amanda talked about some things and Jim talked about some similar things. Now James is going to talk about similar things, and that's confusing because Jim and James also have the same name. That's super confusing. Lots of confusion. Okay, much confusion. Just think about this, right? Take a quick statistic here for you. According to the Tax Policy Center, almost 90% of American businesses are flow-through businesses. That is to say, sole proprietorships, partnerships, and S corporations. So those are the types of businesses we'll talk about here. And those businesses, by the virtue of being flow-throughs, have a direct impact on the owner's tax returns. So that's why when Jim talks about things like the SALT deduction, and you say, hey, Amanda just talked about that too. Well, they are impactful both at the business level and the individual level, because again, almost 90% of American businesses are flow-throughs where the company doesn't pay tax, but rather it flows through income and deductions to owners. Okay, so a reset. If this sounds just like last year at this time, it's only because it is, okay? So for the last 2 year ends, we've had a lot of calls with clients and they say, hey, tax rates are going up, what should I do? And then we heard capital gains tax rates are gonna go from 20% for high income earners to 25, and we layer on the net investment income tax, we layer on the state taxation, and now all of a sudden my capital gains rate, which was within a generation, right, 10 years ago was like 15%, is now on the order of 29% federal plus the state. So hey, maybe I should do some different things. We also talk about depreciation, right? Traditionally, you know, folks would go out at the end of the year and say, hey, I need to go buy a new piece of equipment. Does that still stand this year? All those things, right, you'll note, have not changed. So we've done a lot of planning over the past 2 years to try to coordinate some things. And at this point, that hasn't changed. We'll see what happens to the BBB. As I think both Amanda and Jim touched on, the TCJA, the Tax Cuts and Jobs Act tax reform that went into place in 2018, is set to sunset in 2025. It didn't seem like a long window back at the end of 2017 when that package was going in place. At the end of 2021, it definitely does not seem like a long time frame. It seems like it was sort of a steep learning curve to figure out all these rules, and now that looks like to be sunsetting almost right around the corner. And then what would any tax planning or business conversation be without at least a cursory discussion of PPP? PPP, for all of us to remember, the nightmares, the recurring dreams, the Groundhog Day level of memory here. We had on the order of $7 trillion of stimulus going to the U.S. economy in the past 2 years. Where do we stand on PPP? PPP-1 was in 2020. PPP-2 was in the early part of 2021. Most folks, and I'll say that most folks under sort of the $2 million PPP level are having a relatively straightforward process of applying for forgiveness and getting that forgiveness in a pretty reasonable, not terribly painful time frame. Folks with over $2 million of PPP funding are expecting to have a little bit more thorough vetting process. And we've all seen the newspaper articles that say, PPP was only used by folks who went out and bought Ferraris. But there are plenty of great businesses in America that use PPP to kind of get through a tight time. At this point, I mean, as of today, like right now at 10:55 in the morning, don't hold me to it, There is no new funding on the horizon. But any of us who sort of even have a cursory interest in the news see that we've got a new variant coming out, and what does all that mean? But at this point, we don't see a PPP 3.0 on the horizon. So what hasn't changed? Lots of things haven't changed. Okay, what has changed? The biggest area that we're seeing changes with respect to our middle market clients, right, and these flow through type clients that so much of the American economy runs on, is expanded interest in the Employee Retention Tax Credit, ERTC, or maybe sometimes you'll say ERC. This was a multi-step process. Back in 2020, there was a sort of a rule that said, hey, if your revenue was down 50% compared to 2015, you can get $5,000 per employee. It was a nice benefit, but that was only for very sort of drastic situations. The rules were revised and, if I could say, liberalized, right, to say, hey, you can automatically qualify for this benefit if your revenues were down comparing 2021 to 2019, pre versus post COVID, by 20%, which is a much more reachable level. And the benefit went up to $7,000 per employee. So, okay, lots of numbers, I get it. Let's distill it down to real life. We have real life clients who have worked through this process and found that in one quarter or another, in early in 21, they qualify for this. 50 employees, $7,000 bucks. You're talking about a check in the mail from the IRS for $350,000, right? And so for you know, a normal firm, let's just take any firm that maybe makes a 10% margin on its business, getting a $350,000 check and putting it straight to the bottom line is like closing a $3.5 million deal, right? So that's it's pretty interesting stuff. Keep in mind, right? That is actually any payout in this program is taxable because it's essentially the government subsidizing or underwriting, whether you think of it as payroll taxes or of wages. The government's paying the wages. It's not the PPP where we said, hey, we don't have to pick it up in income and it's forgiven. It's not that, right? But again, I offer to you, if you went out tomorrow and closed a $3.5 million deal that put $350,000 to the bottom line, we would probably go out and have a happy hour in celebration. So while it is taxable and that's not as clear cut as PPP, it's still $350,000 bucks of cash in our example. So that's the safe harbor, 20%. Revenues down in the given quarter by 20%. One quick note, if you're doing that math, if you're saying, oh, I've not heard of this or not paid enough attention to that, let me do that math. Keep in mind that that math is on your basis of accounting for tax. So your internal books are probably on an accrual basis, but many companies are going to file their tax returns on a cash basis for a whole series of reasons we can talk about another time. We have seen a few clients have a scenario where they do all the math based on their accrual books and they say, hey, we qualify. And then say, hey, wait a minute, you're actually supposed to do it on the cash basis, which is the way you file your tax returns. And they, you know, there's a swing and maybe they don't qualify for that kind of all or nothing test. Last, if you run into that scenario, oh, can we go back one moment for just that last bullet point? If you fall into a scenario where you don't qualify because revenues aren't down 20%, or hey, good for you, revenues are up, okay? You're not out of this program. The program has a much more detailed approach, almost like an engineering study kind of approach, something similar to the R&D, research and development tax credits that we've talked about for years, where you can actually go through and look at each of your employees and determine if any of them was affected more than 10% by a government shutdown. And there's like about 140 pages of FAQs and Q&As on this topic. But essentially, if you have, I don't know, so you're an architect or an engineer and your folks can't go out on site to complete an assignment because it's a school and it was shut down, whatever these things were. In a scenario like that, you can actually sort of pick the number of employees who qualify for this credit. And while in our example of a 50 employer company, you might not be able to do all 50 employees, maybe you can pick out 10 that could qualify. Well, 10 times 7,000 is still $70,000. You would still spend, you know, an afternoon or a day doing the research in order to generate 70,000 bucks of net to the bottom line. So if you have questions on that one, it's tremendously complex, but we worked through it with a number of clients. Reach out to your advisor. We'll be happy to walk you through that. Okay, now we can go to the next slide. Great. So the first part of this section was a whole bunch of things haven't changed. Okay. So if a whole bunch of things haven't changed, should I still implement our standard kind of blocking and tackling year-end planning techniques? And I think what we've heard from Amanda and what we've heard from Jim is probably, but let's keep a weather eye toward what does the BBB have in mind, and we can all make up our own minds on how much credence do we put into that passing versus not passing. But if you're in a scenario where you say, hey, I think if something passes, and I think it's got a good chance of passing, I think if it passes, I'm the type of person who will be subject to a higher tax rate in 2022. Or, hey, I'm an S corporation, I'm one of these middle market S corporations, and I'm really getting a lot of benefit from my QBI deduction, right? That qualified business income deduction. Those are really important topics, right? Those could be the types of situations where you say, hey, if in 2022 I'm not going to be eligible for some of these deductions, maybe it makes sense to not do my standard year-end tax planning, right? So for a cash basis taxpayer, and we'll talk about this, we always say, hey, maybe we should pay off as many of our bills as we can. Pay your January bills right there at the end of December to bring income down. Maybe we don't want to do that, right? Because maybe we want to bring income into a year with, I think I'm either going to have lower tax rates or I'm going to be eligible for a number of different deductions. That's really something important. And we have very frank conversations with our clients. Some folks think, hey, I'm just going to deal with the law the way it is. Some folks sort of say, hey, I know the tax rates are going up. Let's deal with it that way. So those are the types of things that are more than just the standard, hey, blocking and tackling. It has some question about what do you think the future holds. Also, we often look at, hey, at year end, do I need to buy a piece of equipment, whether that be a rack full of servers or a boom truck of some description, whatever your business is. Section 179 and 168, that's the 179 is accelerated depreciation, 168 is bonus depreciation. Those have been popular tools for years. 168 now for 5 or 6 years has been 100% bonus depreciation. So if you've got that automobile, you've got that piece of equipment, you've got those blade servers on a rack someplace, those are the types of things that we can take 100% deduction on, even though they're a long-lived asset. That can be really helpful. Again, with a view toward, do I think tax rates are going to rise next year? Because maybe we don't want to bring all those deductions into the current year if we think we're going to higher tax rate regime in the future. One important note on this point, and you'll see the underline here, is that we need to acquire our blade servers or our boom trucks before year end. Yes, fee title, yep, we need to have that. But we also need to have them in service. That is to say, take blade servers because maybe that's easier to think about. If they show up and they're in a box in the server room, they're not really in service, right? So we need to order them with enough lead time that we can get them online and ready to go. It's not a question of when you pay for it. So if you can finance them, you can, receive an invoice and pay in 30 days, however you want to do that. But the actual asset itself has to be placed in service in order to get that accelerated depreciation. Great, and we can move on to the next slide. Okay, so James used funny accounting words. What did he say? He said cash basis taxpayers and accrual basis taxpayers. And then 80% of people went, I know he says those words, but don't really know what that means, right? Essentially, the accrual basis of accounting is what any of us might have learned in business school or something like that, where we say, hey, revenues are recorded when I send my invoice out. And expenses are recorded when whatever that's causing the expense occurs, right? So great illustration of an expense is, hey, traditionally your electric bill for a month is recorded on that month's financials. When do you get the bill for the electric bill? I don't know. The bill comes like 2 weeks after month end, and it's due in 30 days after that. So your electric bill for December might get paid in February or at the end of January, but it's still a deduction under the accrual method in the month in which the economic activity occurred, right? The actual electricity was used, okay? That's the accrual method. That's the book. Like that's the gap. That's the way we learned accounting in school, right? To align income and deductions in the period in which the economic activity happened. But the tax code for years and years and years has allowed us to also look at a cash method of accounting for certain taxpayers. And mostly that's taxpayers will say $25 million of revenue and lower. So for those folks, we can say, hey, we can use the cash method. Well, why do we do this? We do that so we can align our cash receipts to our taxes. We were just looking at a client the other day who had a $750,000 invoice that they sent out. I guess actually they're sending out next week to a client. And they said, you know, the thing is, we're in a little bit of an ambiguous situation with the client. They don't really want to pay it. So we'll call that doubts as to collectability. Be clear, under the accrual basis of accounting, when you send that invoice out, $750,000, you have to pay tax on it, right? You have to pay tax on that, and it's includable in your taxable income. And whether you pay tax on it in January or in April, you're going to have to pay tax on it. And what people hate is, hey, knowing, let's just say we get to April and say, hey, you got to pay tax on that $750,000. But actually, as it turns out, we're still waiting to get paid, right? We've got this ambiguity with our client who doesn't want to pay. We're not sure if we're going to get paid or not. You're talking about a significant, quote, phantom income kind of a situation. So what do a cash versus accrual mean? The cash taxpayer says that taxpayer only pays, only includes in taxable income money that he or she receives, and then actually the checks that they write for their expenses. We often call that the mailbox rule. So if you write a whole bunch of, you go in the office the last week of the year, write a number of checks for expenses and put them in the mailbox, even though the cash hasn't the checks haven't been delivered to the vendor and the checks haven't cleared the bank, they're still deductible on let's just say the 2021 year because you put them in the mailbox. Equally, if you receive funds before the end of the year, again, through the mailbox or through any sort of electronic receipt, that's also includable in taxable income. So the book would say, the sort of old school methodology would say, hey, if you know you're getting paid 30 days on your invoices, wait an extra week before you send your invoices out in December so that they get paid to you first week of January rather than last week of December, because then you don't have to include it in your 2021 income. It's a cool idea, but it's a little bit finicky in practice, right? We don't actually want to delay sending out our invoices and that sort of things. Also, it's possible that people, bonuses and things like that are impacted. Maybe 20 or 30 or 40 years ago, some of the folks might have said, hey, just don't check your mail between Christmas and New Year's, which was called tax planning, I think, back in the day. But that's maybe doesn't fly with the spirit of the mailbox rule. So the takeaway there, if you're on a cash basis, you're not sure, call your accountant. They'll be happy to tell you. If you're on a cash basis, think about any expenses that you have that are going to be due in January and think about whether or not you can afford to pay those before year end. Bonuses and salaries are always one. We've seen this a couple of years ago, I think. December 31st was a Saturday, and we accelerated a bunch of paychecks so that they could be taxable within that year. I think it was 2019 year. So think about whether or not you want to, hey, if payroll is due on Monday and you pay twice a month and it's due on Monday, maybe you accelerate that to the previous Friday and bring that deduction into the year. Accrual basis taxpayers have less flexibility. The one real planning area is the recurring item exemption. And so that's a scenario where things that are deductible each year can be deducted even as long as they're paid within 2.5 months for some items and 8.5 months for others, essentially by the due date of the tax return. So those are scenarios where you've completed the all events test, that is to say, the economic activity has been completed. The easiest way to think about this is accrued bonuses. You get to the end of the year and you say, hey, we pay year-end bonuses based on the full year's activity, and we pay that in the end of January or February. The accrual basis taxpayer can still take that deduction for those accrued bonuses so long as the bonuses are paid before the 8.5, 2.5 test. So there's 3 economic tests. The all events test have people done whatever they need to do in order to qualify for that bonus? Amount certain. Do you know how much the bonuses are going to be? You have to be able to record that. You can't record like an estimate. And economic performance. Has everyone done, by the time you pay it, has everyone actually done it? And then do you pay the bonus within that 2.5 months or 8.5 months by the due date of the tax return? So that's one to think about. It's also a scenario where you want to make sure you have enough cash to pay out those bonuses or accrued kind of expenses before you actually try to take a tax deduction for it. Great. What are some other planning items that we've seen a lot in the past year or two? We continue to think about owner's compensation in the flow-through structure. A few years ago, we really started seeing many clients shift to profits allocations within partnerships rather than guaranteed payments. As long as the profits allocation is structured correctly, it can avoid Social Security and or Medicare taxes, those self-employment taxes. So what are the rules there? Firstly, consult your tax advisor, consult your attorney. But essentially, the payments can't be guaranteed, so they must have substantial economic effect. They have to actually be based on profits. So a guaranteed payment would say, whether we make $1 million of profit or we lose $200,000, I still get my salary, $100,000. A profit allocation is structured that says, hey, I get the first $100,000 of profits, and then we do the math in some other way. If we have a business that is traditionally profitable, then we can make this work. If we have a down year or we have a business that goes up and down over accounting cycles, then that's a scenario where we need to consider whether the guarantee payment versus profit allocation can still be a flexible enough structure. S corporations, well, S corporations and owners' compensation is an ongoing conversation at almost all times, probably since 1986. We always sort of look at reevaluating what represents reasonable compensation for owners. So the sort of basis of the code and the regs say, if you were to hire somebody to do your job, what would they do? So you would say, hey, if I was going to hire an operations manager, I'd pay that person $100,000 a year. That's, quote, reasonable compensation for whatever your job might be. Why do we want to manage that? Well, sometimes we want to bring that reasonable compensation number down, because when we don't pay compensation and we take distributions out of the company, it can again save us those payroll taxes, Social Security and Medicare. However, we have this sort of give and take, because we also may want to say, hey, we'd really like to have the owner of a business max out their Social Security earnings, which is, like, let's just say roughly $150,000. So maybe you say, hey, I'd like to bring my income, my wages down to $100,000 because I save X dollars in payroll taxes. Okay. And be clear, that just means that there's more profit in the company. So it's a zero-sum game. But we might also say, hey, we'd really like to see that the taxpayer, have a maximum Social Security history, so that at retirement, that person can take maximum Social Security and the spouse could take a 50% spousal benefit. And there's some real value there. We can also be in a scenario, if we don't have a lot of employees, where we need to find the right level of wages, because that QBI deduction we keep talking about, qualified business income deduction, has a limit that's predicated on you have to have a certain amount of wages. Essentially 50% of wages has to support the deduction. So there have been times where we've said to folks, hey, we need to bring your wages up in order to maximize the QBI deduction, which net, after we do all our sort of black magic, saves taxes. Long story short, our slide here is not going to tell you what to do, but our slide here is going to remind you to talk to your tax advisors. And especially after the last 2 years we've had, it's a great time to say, are we doing the right thing? And is there any reason that we should bring it up or down? And whatever we've done in the last 2 years is now a time to normalize our compensation type of discussion. Great. So let's move on from owner's comp. What do we see in the fields of M&A and succession planning? Well, if you ask Jim or Stuart or Angelo, who sits just on that side of that wall, we see a ton of M&A. We're getting M&A discussions all the time. Mergers, maybe. Acquisitions, a lot. Our clients seem and often seem to be on the being acquired side, right? The liquidity event side. I think a lot of that goes to continued low interest rates. So rates are low. That means borrowing money is cheap, and that means the private equities out there and the larger firms have enough access to enough funds to go and acquire. From the seller side, as we talked about, folks for years now, 2 years now, have been really concerned about rising tax rates, and so maybe folks have really looked at getting out, making a liquidity event, taking a few years off, and then reevaluating. What do we see in this field? Well, the EBITDA multiple, so EBITDA is earnings before income, interest, taxes, depreciation, and amortization, essentially cash flow, right? cash flow multiples, maybe for a few years, maybe for 5 or 8 years, it was like 3 to 5 times in most kind of industries. Now we're seeing some of those multiples expand towards 5 to 8 range, which is maybe the good old days. Maybe that's the way it was for a few years or many years in the early 2000s. Certainly in tech industries, I don't know, those math, tech, and anything that's cybersecurity related and that sort of stuff, we're seeing, you know, multiples even in the teens, even approaching 20. Though that's those are very specific situations, right? What do we see? We see private equity coming in and buying companies. We also see, as we say, larger companies in an industry consolidating smaller players. The best thing I can tell you is if you're considering an acquisition or if you're considering being acquired, call your advisors first. Quick story, Robin Boyd, one of our folks, and I had a call the other day with a client who had a partnership that purchased an S corporation, and you can't, like, it's not an eligible shareholder for an S corporation. So now we have to figure out what that S corporation has to do. So that can be troublesome. Lastly, internally, we've seen over the last couple of years, maybe more last year than this year, is a real look at gifting and succession planning, whether that's someone outside the family and saying, hey, key employee, let's figure out how to bring you on board, or it's someone inside the family to say, hey, we'd like to go ahead and gift this to you while the estate tax exemption is as high as it is. We've started to see those things. And we've also seen sort of way back machine here, go back to 2010, we've seen SLATs, spousal limited access trusts, become popular again. These are pretty significantly complex vehicles that essentially allow spouses to set up trusts for the benefit of the other spouse in order to get the growth, future growth in assets out of their estate. The concept being that if you could get assets out of the growth out of your estate and your spouse has access to them, well, hopefully later in life, your spouse will let you live in their house or fly in their airplane or ride around on their boat. But, you know, to each their own, right? But this is another place where we've seen, if we think the estate tax exemption is going down, there's a lot of folks out there looking at how to lock in the roughly $22 or $23 million of estate tax exemption that exists today. Great, and I think we have one more slide here. The last one, if the phrase pass-through entity election brings chills, we apologize for that. Many of you will have memories of saying, hey, I didn't get my tax returns done until September of 2021. That's the latest they've ever been. I wonder why that is. You'll recall that Jim and I and folks like us spent the whole summer telling you, in 4 to 6 weeks, the forms will be ready. In 4 to 6 weeks, the forms will be ready. And then they weren't. We ended up getting the forms from Maryland, and so just go back one step because I'm a history kind of guy. The law was passed in June of 2020. The forms were not even sort of set up until early in 21. And then when the forms came out, there was a comment period, and the comments were vast and widely arrayed. There were a lot of technical things that the industry needed to help the state see. The forms were updated and revised throughout the summer until we basically got to the point in late August where we had to file returns. Certainly, it's our hope, and it's everyone's expectation that that won't be the case for tax season 2022, tax year 2021. Okay, so remember, what was the purpose of all of this runaround, right? So as Amanda and as Jim told us, the SALT tax, the state and local tax deduction, itemized deduction at the individual level was limited back in 2018. I'll get off my soapbox and not talk to you about the effect of the alternative minimum tax because nobody cares. But at the end of the day, 22 states, including Maryland, now have workarounds that allow businesses to pay an entity level tax, which is deductible, in lieu of or on behalf of their owners. Now, okay, that's not here nor there. But last year, the IRS came out and said, hey, we will respect a deduction for that. So what that means is now the company is going to pay a state tax for its owners, and the federal government's going to give them a deduction for that. The states, however, said, wait, that's great, but I'm not giving you a deduction. Like the states are net zero, so you end up with an add back at the state level. And a really important thing to remember here is, and people have looked at this and sort of, it's hard to sometimes keep the storyline. There is no state benefit. The states are net zero. All it comes down to is a federal benefit. This might be easier if we look at some numbers. If you look at the sort of the blue at the bottom of the page there, if we had $100,000 of profit and we're in a state like Maryland with an 8.5, let's just call it 8.5% tax rate, we can cause the company to pay $8,500 on behalf of owners. Great. It's a federal tax deduction. Remember, no state benefit. Federal tax return at the entity level includes this $8,500 deduction. And let's just say the owners are somewhere between a 30 and 37% tax bracket. The owners in this scenario are going to save between $2,500 and $3,000 roughly in tax benefit. So you're saving 2.5 or 3% of your profit. Okay, if you take that $100,000 number and you make it $1 million number, then you just add a zero onto the structure, right? And so for a company with $1 million of profit, the owner group might save between $25,000 and $30,000. Now you're talking about real money. So the game plan here is keep in mind that in order to be deductible in 2021, the payment has to be made in 2021. You can certainly make the election on the form when you file it in 2022, but if you want to accelerate that deduction into 2021, you need to do some projections. You need to try to figure out what you think taxable income is going to be, and then you need to include that payment before year end, before December 31st. So maybe we can think about some of the downside or complications. A number of states like California and New York have contradictory rules that say they're going to respect S corporations versus partnerships, or maybe partnerships versus S corporations. This is an actual downside. If we had a scenario with a New York-based partner, and so we said, hey, we're going to do the Maryland PTE election. That's great. The Maryland-based partner was going to save $25,000 super, but the New York-based minority partner, New York, was not going to accept, or may not accept, the Maryland credit because it's not an individual credit; it's a business credit. And if New York didn't accept that credit, then the New York-based taxpayer was actually going to cost that person $10,000. And as you can imagine, the Maryland person was saying, hey, I'd like to save $25,000, and the New York person was saying, that's great, but I don't want to pay an extra 10, essentially due to double taxation. So that's quite a nuanced situation. It may be that the genie's out of the bottle on that, and that's going to be something we have to deal with more and more going forward. So let's see, do we have a polling question? We do. Okay. State pass-through entity tax payments generate which kind or kinds of tax savings? State tax benefits, federal, neither or both.
Why can't I vote?
Federal, very good. So what do you want to do, Jim? Do you want to do
We have a bunch of questions. We can try to rip through them quickly. I'll take the first one. Someone asked if we could repeat the percentage of the potential new tax surcharges. So that would be a surcharge of 5% of your taxable income that's once it exceeds $10 million of AGI. So it's an incremental extra tax. The percentage is 5% for AGI over 10, and an additional 3% if your AGI is over 25 million. So in other words, if your AGI is 26 million, you're going to have an 8% surcharge on $1 million. So that sounds unattractive. Another question was around the potential change to the net investment income tax. I'll tackle that one, James. That would be, according to the latest version that I've seen of the Triple B, effective in 2022, not in 2021. And then related to that, so the math is interesting here. The net investment income tax is 3.8%. So what someone might say, well, I have an S corporation, James, right? And I have a $500,000 profit. Well, I would like to minimize, and before this profit was not subject to net investment income tax, right? Because I'm an active owner. But now in 2022, this law comes through and I am subject to it. Well, maybe I'll just take a bonus of $500,000 and avoid the net investment income tax, Jim. And that might sound like a good idea, but if you do that, you're going to pay a couple of taxes. One, you're going to pay Medicare tax, which is unlimited on your bonus of 1.45%. The employer, your company, is going to pay the same tax, 1.45%. You add those two numbers together, you get to 2.9%. And if your W-2 income is over $250,000, then you're paying a Medicare tax surcharge of 0.9%. And James, correct me if I'm wrong, but 2.9% plus 0.9% is magically, actually not magically, 3.8%. So
what they were doing.
I think, while politics aside, I don't know if I like this. It's actually pretty smart. It's going to close what's been called the S corporation tax loophole to some extent, where you don't pay self-employment tax on business income is allocated to a shareholder. And effectively, you're being told whether you take salary or allow the profit to come through. If your adjusted gross income is over $500,000 for a joint taxpayer, we're either going to get you with Medicare tax and matching Medicare tax, or I'm going to get you with self-employment tax, or we're going to get you with net investment income tax. They're kind of not allowing a window to escape those taxes. James, can you see the ERC question?
No, I can't, Jim. If you read it to me, I'll try.
I can read it. The question was, it had to do with the taxation of the, we were saying, you said the ERC, the credit itself is taxable, but what it really means is there's a reduction in your wage expense, correct?
Yeah, exactly. The deductions are, the fact that the government is essentially paying your deductions means that you lose deductions. So whether you think of it as putting it into other income or you think of it as subtracting it out of deductions, the net effect is more taxable income.
You got it. And then one nuance here in Maryland, and I actually just got confirmation while I was listening to James, trying to multitask, from the comptroller's office. Unlike some other credits related to wages in the state of Maryland, i.e. the work opportunity tax credit, the federal government is saying, we'll give you a credit, but we're not going to let you not pay tax on that. That would be like a double benefit. And we'll put PPP aside, where you probably had a quadruple benefit. Maryland, for the work opportunity credit, would say, hey, we're not giving you a credit. The feds gave you a credit, so we'll let you take your full wage deduction. There is nothing in the Maryland statute that will allow you to have a subtraction to make you whole in Maryland for the loss of the ERC related wage deduction. So just more math to keep in mind. Certainly if the credit is available to you, go get it, but you will pay federal and state tax on that wage reduction. And I think we're probably out of time. If we have more time at the end, we'll try to answer a couple more questions. But I believe we want to turn it over to Michael Bondi and Stephanie Johnson.
Thank you, Jim. And thank you, James. So that brings us to what I believe is the most exciting and the most fun part of the presentation, because essentially all that stands between all of us and the end of this presentation and lunch is ourselves. So before we get started, this is the corporate income tax section. I'm a principal with the C Corporation Income Tax Group. Stephanie is our star manager, and we're going to talk a little bit about some of the thoughts and planning around corporate C Corporation income tax planning for year end. And we're going to kick that discussion off with a polling question. So I'm not sure how many of us this has applied to, but this was actually a pretty neat and applicable opportunity that was offered under the CARES Act. And I hope many of our taxpayers afforded themselves of the opportunity. And it's something that we are still seeing the ramifications of, which should give you a hint towards the answer. So we'll give that about a minute, see where everyone is. And I don't get to vote. But it looks like most folks answered it correctly. It is 50% repayable. I just made up that word. 50% of any payroll taxes, employer share payroll taxes that was deferred, 50% of it repayable by the end of this year, the other 50% repayable by the end of 2022. Having said that, what we're going to do is turn things over to Stephanie, who's going to talk us through some of the changes, some of the things that we're looking at for this year end, and take it away, Steph.
So I just mentioned the 163J changes. So we're back to 30% limitation on ATI for tax years in 2021. And also in 2022, taxpayers will no longer be able to add back expenses related to depreciation, amortization, or depletion when calculating adjusted taxable income when computing 163J. And you'll also want to note that under TCJA, the 100% bonus depreciation deduction will begin to phase out after 2022. So for eligible fixed assets placed in service during 2023, the bonus deduction will be limited to 80% and will be reduced by 20% annually thereafter until it is fully eliminated in 2027. And so we can move on to the next slide. We're still working there. Some tax planning considerations for the year. As we wrap up 2021, qualifying small businesses, generally those with average gross receipts under $26 million, who elect to file as a cash basis taxpayer, should consider tax planning strategies to reduce taxable income for the year, such as accelerating year-end expenses and deferring revenue, as James had discussed in his section previously. Now, taxpayers of any size should consider analyzing their business meal expenses, as this may be an opportunity to pick up some additional deductions on their return. As part of the Consolidated Appropriations Act of 2021, taxpayers are generally allowed to expense 100% of certain business meals purchased from qualifying restaurants between January 1st of 2021 and December 31st of 2022. This deduction will apply to both dine-in and carry-out meals. However, it does exclude purchases from businesses who sell prepackaged food or beverages, such as grocery stores, and it also excludes eating facilities that are located on the employer's business premises. Now, after this period, the deduction will revert back to 50%. And another area that taxpayers should be aware of relates to the deductibility of research and development expenses. Under the TCJA, changes to the tax deductibility of R&D expenses are set up to go into effect for tax years beginning after December 31st, 2021. Prior to this, taxpayers could choose to either immediately expense these R&D costs in the year in which they were incurred, or they could amortize them over a period of at least 60 months. However, starting in 2022, the option to immediately expense these costs is eliminated, and taxpayers will instead be required to amortize them over a period of 5 or 20 years, depending on where the costs are incurred. And circling back to the poll question, just an extremely important reminder for taxpayers who opted to defer payment of their employer portion of payroll taxes under the CARES Act. The first installment is due of 50% on December 31st, 2021. So you'll want to make sure you get that in this month. And the remaining amount is due by December 31st of 2022. Now I want to touch on a couple quick items related to state income tax considerations. Taxpayers should be mindful that with many of the state of emergencies ending in 2021, Nexus relief as a part of COVID has begun to terminate. Going forward, employers will need to consider the impact of employees who continue to work remotely out of state, as this may now trigger Nexus and create additional state income tax filing requirements. And taxpayers who file in Florida, Indiana, Louisiana, and Oklahoma should take note of changes to income tax rates in those states beginning in 2021. And while most states now conform to the federal guidelines for deductibility of PPP loans forgiveness, Rhode Island and Virginia have set limits on the deductibility of these forgiven loans. So you want to take that into account when working on your estimates for the year.
And I think, Steph, these three areas of state taxes is something that I know that we've been asked a lot of questions about. And this is really something that we want to make sure to have a specific focus on and make sure that our listeners are well versed in or aware of, at least in terms of where folks get hired, where people are sitting and doing work in the coming year. I know that that's been an issue across the board, across so many industries, as we face a talent crunch, and the competition has become fierce for talent, and we're finding our clients and we're finding our prospects looking to hire folks all over the place. And as we do that, it's almost become rote to say, well, that's okay, because we have this one-time COVID pass where it really doesn't matter where our employees sit and do our work. It's just something we don't have to concern ourselves with. As we, despite what the news may say, as we start to exit, the throes of the pandemic, and these rules expire, it's really something that could potentially have I'm not going to use the word material, but a significant effect on our clients, on their state tax liabilities, on filing responsibilities. And we just want to be mindful and thoughtful about where our employees sit, and so that it should be part of the conversation. And that's certainly something that is important, and I'm really glad that Steph tackled that one. And I think Steph, to your last point about PPP loan forgiveness, when Steph and I were discussing, the issues that we wanted to bring up and raise awareness about, and one of them was PPP loan forgiveness, and we talked about how this reads and how this looks, and we talk about Virginia excluded up to 100,000 and taxable above that. I think, Steph, we wanted to make sure that folks understood what we mean. It sounds a little odd, but the understanding of that note is, up to $100,000 of the amount of income that was recorded for financial reporting purchases is tax exempt. Above that, any amount above $100,000, and I'm just focused on Virginia for the moment, because geographically it's so close to us, anything above that is no longer tax exempt income, and that becomes taxable there. And that's, again, something that Steph and I have seen have a significant effect on our clients and their tax liabilities in these states. So certainly something to be mindful of, particularly as we get towards year end. We're thinking about estimates, we're thinking about how the year ends, we're thinking about extensions and what our tax liability may be. This is something that we've seen a lot of attention drawn to. Steph, anything to add there?
Nope, I think that covers it. Definitely something, or areas that should be considered in tax planning, very important for the year. Yep. So we can move on to the next slide. So speaking of estimates, when calculating the tax payments for 2021 and 2022, taxpayers should consider changes to apportionment factors. Alabama, Maryland, and Montana have changed their methods of computing these. So you want to take a look at that to see if they have any effect on your payments so that you can avoid potential underpayments. There's a couple random state items. taxpayers with NOLs in California need to be aware that the state has suspended NOL utilization for tax years 2020 through 2022 for any corporations with taxable income exceeding $1 million. The Illinois Income Tax Act had some changes that were enacted over the summer, which may cause an increase in tax liabilities for corporate taxpayers. For the year, they will be disallowing certain federal tax deductions. And as a result of these changes, businesses in file in Illinois will need to determine what effect this will have on their 2021 tax liability, as they may now face themselves owing taxes for the year when they previously may not have paid estimates previously. And I thought this was interesting. North Carolina passed the 2021 Appropriations Act in November, which includes the phase out of state income tax starting in 2025. So if you file there, it's a long-term area to consider for how the rates are going to go. So that was pretty much everything I wanted to cover in this area. Michael, do you have any comments on any of that before I hand things over?
No, I think that's excellent. So we're seeing a lot of changes. I think it's just something to be mindful of. It's to put the conversation out there and be thoughtful about these changes. Again, we're speaking, we're speaking to someone who, to a company that has, its operations that is subject to income taxes in various states. There's not more movement than usual, but these are some of the more significant changes that we're seeing. Again, just meant to trigger in our minds things to look out for. Okay. So what we're going to do from here, thank you very much, Steph, by the way, that was fantastic. Thank you for the update. Very, very well done. What we're going to do, move on from here, is think about some opportunities that are not necessarily brand new. They're relatively new in terms of the Tax Cuts and Jobs Act that was in effect, that was enacted at the end of 2017, but something that not everyone, not every taxpayer seemed to have necessarily picked up on right away. And as time has gone on over the past couple of years, and as we are emerging from COVID, and there's, let's say, more time, patience, and tolerance for looking at more opportunities, and as folks become, businesses recover, folks become more taxable again, and the world reopens, we may be looking at some opportunities for our corporate taxpayers in this regard. One of them is what's known as FDII. So any corporation, rather every corporation, that has gross income from export activities leaving the US should be thinking about the foreign derived intangible income. That's what FDII stands for, deduction. So Congress had added the Section 250 to the tax code, and with it, the FDII deduction, to provide an incentive to domestic corporations in the form of a lower tax rate on income derived from tangible and intangible products and services in foreign markets. So despite the misleading name, foreign derived intangible income, it's not just intangibles. Export sales of tangible products generally also qualify for this deduction. To quantify it in terms of a percentage, if this export activities are qualified, a corporation can claim a 37.5% deduction, which results in a permanent tax benefit and a 13 and change effective tax rate on that income, as compared with a 21% corporate tax rate. And this is for tax years beginning after 2017 and before the January 1, 2026 tax year begins, after which time the deduction is reduced to 21.9, let's say, percent, which would give a slightly higher effective tax rate on that income of about 16.5%. Now, as pretty much every presenter before me noted, back on November 19th, the House passed a version of the Build Back Better Act, and that had excluded many of the tax provisions that were included in the version that was originally introduced in September. The expectation is that before this bill passes in any form, additional changes will very likely be made to the tax provisions included in the current version of the Act. But having said that, the House-passed version of the Act reduces the applicable percentage for the FDII deduction that we just mentioned from 37.5% to 24.8%. So less of a benefit there. Incidentally, and I'm mentioning this because they're really part of the same tax code section, the House-passed version of the Build Back Better Act also reduces the applicable percentage for the global intangible low taxed income, or the GILTI deduction, from 50% to 28.5%. For those of us who need a tiny, quick refresher, GILTI income, the GILTI deduction rather, comes through in the form of a company that has foreign subsidiaries, okay? So GILTI is total active income earned by US shareholders' foreign affiliates that exceeds 10% of the company's depreciable tangible property, which essentially says income that's earned, net tested income that's earned by US shareholders' foreign affiliates are taxable currently in the US, but there is, generally speaking, a 50% deduction for the income that's recognized in the US on those foreign affiliates. So we generally get a 50% deduction on the income that we recognize from our foreign affiliates. Well, that, in the current version of the bill, would be reduced from a 50% deduction to a 28.5% deduction. These proposed changes will result in would result, not saying will, they would result in an effective FDII rate of 15.8% and an effective GILTI rate of 15%. And these changes would be effective for taxable years beginning after December 31st, 2022. So moving on to our next issue, this is not an opportunity, but rather something that I think we've seen more of our clients have questions about, and it's pertaining and to more of our clients as time has gone on. And there's some clarity, and that is BEAT. So the base erosion and anti-abuse tax, which is what BEAT is known as, is essentially an alternative minimum tax that's imposed on US corporate taxpayers making what are known as base erosion payments. So these base erosion payments are generally most expenses that are paid or accrued by US corporations and US branches of non-US corporations that are applicable taxpayers, that term is important, that are applicable taxpayers to foreign related parties for which a current deduction is claimed or allowed. BEAT adds these back to taxable income. So then if the result of adding these expenses that are paid or accrued by a US corporation, if the result, what's known as modified taxable income, multiplied by the applicable tax rate, exceeds the regular tax liability, so it's some math that's done on the side, and if that amount, that result exceeds the company's regular tax liability with certain adjustments for tax credits, the corporation is then subject to BEAT, this minimum tax, in addition to the regular tax. So who are these applicable taxpayers? In general, these are corporations with average gross receipts exceeding 500 million that are subject to this minimum tax. Now, there are affiliate rules. So a company that is connected in certain ways of ownership to other certain ways of ownership to other companies, whether you're connected to a public company somehow, whether you're connected to other US affiliates, even through foreign ownership, this might apply. So I would not dismiss this as inapplicable just because we hear the number 500 million in gross receipts. But in any event, the 500 million threshold, it's subject to a minimum tax generally equal to 10%, scheduled to increase to 12.5% in 2026, multiplied by the excess by which the BEAT liability exceeds the regular tax liability. there is a de minimis exception rule that generally allows up to 3% of a corporation's total deductions to be made to foreign affiliates before BEAT applies. So those would be exempt. Noting that the Build Back Better Act would increase the BEAT rate to 12.5% beginning in 2023, 15% beginning in 2024, 18% beginning in 2025, and would eliminate this de minimis exception beginning after 2024. So I think at this point, we just want to jump to the next one. This is a summary. We've talked about a number of these things. I just want to touch on one of the bullet points that are listed here, which is on the newer end of these initiatives in the bill. Most of them have been discussed in some form or another. One of the ones that's sort of new is the interest expense component, the 163J interest expense limited to 100% of net interest expense. That's actually what this would do. That's actually speaking to the House bill that would that is thinking of imposing an additional limitation to interest expense. This speaks to domestic corporations that are included in the financial reporting of an international group. And what that would do is, under this provision, the interest deduction is limited to an allowable percentage of 110% of net interest expense as reported in the group's applicable financial statement. And this applicable percentage that we're talking about refers to the ratio of the corporation's allocable share of the group's net interest expense over the corporation's reported net interest expense. That's how you get to the 110%. So it's their share over the corporation's reported net interest expense. You come up with a number, and that's limited to the 110%. The domestic corporation's allocable share of the group's reported net interest expense would be that corporation's share of the group's total EBITDA. So as far as applicability goes, it's an interesting rule. It's sort of it sort of makes you think twice because of the 110% number, but that's just some math that has to be done, and it could potentially apply to domestic corporations that are connected to a group filing that includes an international group. Only domestic corporations with a 3-year average net interest expense that exceeds 12 million would be subject to the new limitation. The new limitation would only begin years after December 31st, 2022, and similar to the existing 163J rules, would allow for an unlimited carry forward for any currently disallowed deductions. So with that, I think we've exhausted our C Corporation tax topics and planning for the year. And I think we've had a couple of questions, and that pertains to, so the couple of questions we received, one of them asks, is the PPP taxed in the state where the employees work or where the corporate headquarters is located? So as far as that's concerned, so the PPP loan by itself, by definition, so we start with federal taxable income. So the PPP loan is recorded as income for financial reporting. For income tax purposes, for federal income tax purposes, it's considered tax exempt income when it's forgiven, or in the period in which it's forgiven for financial reporting purposes. And then the state, we look at it on a state-by-state basis, right? So it's not where the employees work. So the question, I guess the question is worded, is the income sourced to the state where the employees work or where the corporate HQ is located? And that would be, to me, that would be in the state, that income would be sourced where the corporate HQ is located. That would seem to me the answer. And then the other question is, so then you know, the company's headquartered in Virginia. The income is sourced in Virginia, and then we have to look at Virginia as to whether the Virginia rules as to whether it's tax exempt or not, and we've already touched upon that the first 100,000 is exempt. We then look at if you had a PPP loan forgiven and you have payroll in several states, do you allocate the PPP loan as income based on the states and payroll? Essentially the same question. The PPP loan, we wouldn't break it up according to the payroll that was paid out. Now understand, if I'm thinking about this correctly, it would seem to me the question is, do we have to connect the specific amounts of the PPP loan to the payroll that it was used to pay, and it gets sourced to a state based on that? I don't think that's the answer. I think the loan is properly sourced at where the company is headquartered, and then we would just look at it on that basis. That's where it would get sourced. I don't think we break up the PPP loan on a state-by-state basis. Steph, have you come across this? You're muted. That's okay. Yeah, I don't see this as connecting. We don't connect the state payroll wouldn't necessarily be connected to the PPP loan, because the PPP loan proceeds were theoretically used to pay payroll, to make payroll. That wouldn't tie it on a state-by-state basis. I think those two concepts stay separated. The other question that we have for the Virginia PPP loan forgiveness limitation is that $100,000 per year. If not lifetime limit, then affected clients should pause PPP 2 forgiveness apps. And so what that is, that would be that $100,000. I think that is per tax year. I don't think it's a lifetime limit, but I think that's a per tax year. So if you had one in 2020, those taxpayers recognized one in 2020 and may have two in 2021. That's $100,000 per year, as far as I understand the rules. I don't think there were any other questions. So let us turn this back over to Andrew.
Thank you, Michael, and thank you to everyone for attending today's webinar. Please don't forget to complete your evaluation survey once you receive it via email. That should come out in probably the next hour or so. And then on Monday, we'll have the recording and presentations sent out to you as well. So thanks again, everyone, and enjoy the rest of your day.